Welcome back to Griffonomics, where we conduct financial investigations to define the risk before we look at the reward. Today we're diving into Saia Inc., ticker SAIA. This company is making these massive, front-loaded, long-term bets in what is an incredibly challenging LTL freight environment.
Yeah.
And the current financial results, well, they're showing the distinct pain of that strategy.
They absolutely are. Saia is executing a front-loaded infrastructure expansion to secure a 6.8% market share, and that's up significantly from 4.0% in 2017. They're positioning for high operating leverage where every 100 basis points of revenue improvement can yield $3.91 per share in earnings, despite a muted macro environment that pushed its adjusted operating ratio to 87.6% in Q3 2025.
That thesis right there is the definition of a classic grow now, profit later story. So for you, the listener, the mission here is crucial. We need to unpack exactly what painful short-term costs Saia is absorbing right now for that massive potential future payoff. We're basically wading through the current market sludge, the low volumes, the high costs, to find the actual gold mine they're convinced they're building.
And before we get into the Q3 numbers, we really need to define the key metric here. The operating ratio, or OR. In trucking, this is everything.
Right.
So the operating ratio is your operating expenses divided by your revenue. It tells you how much it costs to generate $1 of revenue. If a company has an OR of, say, 90%, they're spending 90 cents to make a dollar. That leaves 10 cents as profit. Saia's strategy is forcing that number higher right now because they're absorbing costs for terminals that just aren't running at full capacity yet.
Okay, so let's start there. Let's look at the cost of this expansion in the current market. Because Q3 2025 was tough. Consolidated operating revenue was basically flat year over year. It showed a slight decrease of just 0.3%, totaling $839.6 million. And that flat top line, when you combine it with the heavy investment, that's a recipe for a margin shock.
It absolutely is, and we see that shock so clearly in the OR. When heavy fixed costs from new buildings meet weak demand, your efficiency metrics they take an immediate hit. And that's exactly why the adjusted operating ratio increased 250 basis points to 87.6%. Just a year ago, it was 85.1%.
Wow. So moving from 85% to almost 88%, that means they're spending nearly 3 cents more on every single dollar they earn.
Exactly. That widening ratio is the direct consequence of all that underutilized capacity. You know, they essentially built the stadium for the Super Bowl, but we're in the preseason and the crowd hasn't shown up.
And the volume metrics seem to confirm that. This isn't just a temporary softness, it's persistent. Looking at LTL, less-than-truckload, shipments per workday, which is, the fundamental unit of work for Saia, that decreased by 1.9% year over year in Q3. LTL tonnage was also down 1.5%.
And the concern really escalates when you look sequentially into Q4. The softness isn't showing signs of an immediate recovery. Management noted that October shipments were down around 3.5% and tonnage was down about 4.0%.
So it's getting worse.
It's a significant deceleration right when they need the volumes to start filling those new terminals and driving down that high operating ratio.
And that softness, when you combine it with inflation on the cost side, that's the 1-2 punch that's hitting the bottom line. Let's dig into where the costs are escalating, because it's not just depreciation on new buildings.
Precisely. If you dig into the expense side, the pressure is really driven by rising operational costs, specifically liability and labor. We saw a really significant 22.5% year-over-year increase in accident claims and insurance expense.
22.5%, that's a massive number.
It is. And that jump is driven by the development of existing accident claims, so older claims getting more expensive and just straight-up inflationary increases in the cost per new claim.
We hear about inflation hitting groceries, but here it's hitting the high liability, legal, and medical costs of a major accident. That's a structural headwind that's completely out of management's control.
It's the hidden cost of running a massive fleet in a litigious and inflationary environment. And on top of that, salaries, wages, and benefits also increased, though by a smaller 0.7% year over year. But even that was mostly cost inflation, hitting things like group health insurance and workers' comp. They're paying more just to maintain their existing team and manage their risks, all while waiting for the volumes to show up.
Okay, so let's look at the plan. They're taking this OR hit for a reason. Let's pivot from the pain and focus on what they're building, this massive network expansion. This is the big story. Saia is aggressively building a national network to capture market share, opening 69 terminals since 2017.
And this strategy is all about seizing territory. LTL, unlike full truckload, is fundamentally a network game. Your value to a shipper is directly tied to how many doors you can serve, which means terminals are the core strategic asset. So opening 69 of them, They've gone from a regional player to a true national contender.
And they didn't just build them from scratch. They timed their push perfectly to capitalize on what was happening in the industry.
Absolutely. The key move here was the timing around the Yellow Corporation bankruptcy. Saia was able to acquire 17 essential freight terminals from Yellow in January 2024. That wasn't just adding dots on a map, that was acquiring premium real estate they would have spent years developing on their own. And the timing is fantastic because the LTL Producer Price Index, the key measure of pricing power in the sector, is sitting at a 10-year high. The market is structurally tight.
So what does this massive build-out actually achieve? What's the end result in terms of market access? Because this is where the market share play clicks into place.
Well, the expansion is essentially complete from a geographic coverage standpoint. This new footprint gives them direct service coverage to, get this, 99% of outbound industry revenue.
99%.
They are now officially a leading nationwide carrier, direct service to all 48 contiguous states. They have the physical infrastructure they need to go after that 6.8% market share target.
What's fascinating is that even with the market in this slump, October shipments down 3.5%, remember, management is holding the line on pricing. That suggests the structural undersupply in the LTL market isn't just a theory. It's real. It's giving them leverage.
It absolutely is real. Management is confident because that market undercapacity is quantifiable. We're talking an estimated 60,000 to 80,000 supply-demand gap. The industry simply doesn't have enough functional capacity, so they're using that imbalance to their advantage. We saw two specific pricing actions that illustrate this. First, the company pushed through a chunky 5.9% general rate increase, or GRI, on October 1st, 2025.
But wait, how much of that 5.9% is just covering that 22.5% jump in claims costs?
Yeah.
Are they truly capturing price or just running to stand still against inflation?
That's a critical question, and the second metric helps answer it. The other pricing action shows true capture. Their contractual renewals netted a tangible gain of over 4% revenue per bill in Q3 on a like-for-like business basis.
Okay, so that suggests real pricing power.
Exactly. It's driven by that supply shortage, not just a reaction to their own internal costs. They are successfully passing through costs and extracting a margin on top.
All right, let's turn to the whole reason for this pain: operating leverage. If they have this massive, expanded, but currently underutilized network, the investment thesis is simple. The network is built for a future volume surge, so small incremental gains in volume should yield disproportionately high returns.
That's the core mechanical argument, yes. Because their costs are front-loaded, they already built the terminals and staffed them. When volume returns, very little of the new revenue gets eaten up by new fixed costs. That's leverage in action. For every new piece of freight that goes through that network, a higher percentage of the revenue drops straight to the bottom line. That's how you get that compelling figure from the thesis. Every 100 basis points of revenue improvement can yield 91 cents per share.
A massive multiplier.
Right.
But we need to know if this model actually works in practice, especially in those new facilities. What are the metrics coming out of the newest terminals that prove this isn't just a pipe dream?
We have clear evidence. We can look at the 39 ramping markets. Those are the terminals open since 2022. Despite being immature and operating in this soft market, they are already achieving a sub-95% operating ratio.
Which, for a new terminal in a down market, is really good.
It's a very strong sign of underlying viability. And what's more encouraging is the trend. These ramping markets improved their OR by over 100 basis points just from Q2. They are getting better faster.
And efficiency isn't just about waiting for volume. Technology is optimizing the network ahead of the surge. You mentioned they're using AI-based tools to redesign their line haul network.
That investment in AI is critical because it's reducing friction in the network before the real volume even arrives. The explicit goal is to reduce what they call peak handles.
For our listener, can you clarify what a peak handle is? Why does reducing it matter so much to the OR?
Sure. A handle is basically every time a shipment is physically touched, sorted, loaded, unloaded as it moves through the system. The more handles a shipment needs, the higher your labor cost, the higher the risk of damage, and the slower the whole process is. The AI is optimizing routing to bypass intermediate sorting facilities when it can. It's all about reducing those expensive manual touches. Fewer touches mean lower labor costs, less risk, and higher velocity.
And are we seeing that pay off yet?
We are. Management has confirmed that network handles are already lower than their Q1 peak. This indicates their past peak pain on those internal efficiency costs. They're getting structurally leaner right now, even before the market turns up, which means the benefit of that eventual volume surge will be maximized because the underlying cost structure is already getting optimized.
Okay, but to bankroll this whole expansion during a period of rising costs, you need a seriously healthy balance sheet. Let's talk about the financial health supporting the strategy.
The balance sheet is exceptionally strong, which is highly reassuring. The company maintains excellent financial health. For perspective, the net debt to total capital ratio is just 6.8%. And maybe even more telling, the net debt to EBITDA ratio is only 0.2x.
0.28. That's functionally zero leverage in a capital-intensive industry. It tells you they built this whole national network without mortgaging the farm. They can ride this out for years if they have to.
Exactly, and the debt maturity profile supports that. They're not facing any immediate refinancing risks. 99% of their borrowings won't mature within a year. They've secured the runway they need.
And beyond just having a strong balance sheet, management is acting like a responsible steward of capital. They're adjusting spending based on the reality of the macro climate.
Yes, we are seeing real capital discipline. They are significantly reducing their anticipated 2025 net capital expenditures from the original projections, bringing them down to about $550 to $600 million. This is management basically telling us, we've built enough chairs for the party, now we need people to sit in them.
And they're planning even further deceleration for next year, right? Confirming this pivot from expansion to generation.
That's correct. Management is further reducing their 2026 CapEx projections down to $400 to $500 million. This reflects prudence. The focus is shifting from building the footprint to generating a high return from the capacity they already have.
So let's synthesize the final verdict. We have this core conflict. A heavy, front-loaded investment meeting continued macroeconomic disappointment. Is the waiting worth the pain?
The bull case is incredibly compelling because the structural tailwinds are so powerful. The operating leverage is clearly demonstrated in those ramping markets. The market share gains, especially those sticky ones from Yellow's bankruptcy, are foundational. And the LTL market remains acutely supply constrained, which gives them a strong floor on pricing power. I mean, it's a high conviction bet on an eventual recovery.
But the downside is immediate and tangible. The bear case starts with the obvious: continued volume softness. We noted October volumes were down 3.5% in shipments. If the economy stays sluggish, the waiting period for that payoff just gets longer and the OR stays high. Then you layer on the long-term regulatory hurdles, particularly the California Air Resources Board CARB and its advanced clean fleets mandates. Those phase in aggressively starting in 2027.
And that CARB challenge is the real technological anchor risk that investors have to grapple with. It mandates a massive, costly fleet conversion to zero-emission vehicles, but currently there are, and I'm quoting here, virtually none suitable zero-emission replacements for the heavy-duty trucks needed for LTL freight. This isn't a small problem. It's a potential multi-billion-dollar forced conversion risk.
So the stock isn't just a bet on macroeconomic timing. It's a high-risk bet on technological innovation solving a massive regulatory problem on a government-mandated timeline. If the ZEV tech doesn't evolve fast enough, Saia could be stuck with stranded assets in California or just absorb massive, low-return conversion costs.
It creates this fascinating juxtaposition where Saia has perfect execution on its network strategy, but faces this completely unpredictable external risk from technology and regulation.
It makes you wonder, though, considering the AI-driven optimization that's already reducing those internal handles and costs, how much value is already locked in with the current network efficiencies, even if that macro volume surge takes another year to show up. That operational excellence could be a stronger, technology-driven moat than the waiting market currently appreciates. Risk defined. Portfolio protected.